Let's take a closer look at these Canadian jobs data. Employment grew by just 7,400 positions in April, and all of the growth was from public sector jobs. And the jobless rate rose to 6.9%. We're joined, there's a look at the unemployment rate. Look how it exploded during COVID, then tanked, but it has been edging steadily higher. Let's get more from Charles St-Arnaud, chief economist at Alberta Central and a former economist at the Bank of Canada. Charles, great to see you, and thanks for coming on the show. What jumped out for you? What was the number one thing for you with these jobs numbers?
Well, I think it's when we look at the balance of where jobs are being created and where they're being lost, you can clearly see that the number, actually, the monthly number would have been much worse if we didn't have the election in April. Like, we've had a gain of a bit more than almost 37,000 workers in the public sector, most of it due to temporary hiring for the election. So that kind of suggests that without that, we would have had a big decline in general employment in Canada, especially led by the manufacturing sector.
Jobs, they don't adjust for that. I guess they can't adjust for everything, but you think they try to back it out in some way, a one-off thing like an election?
Well, no, those are actually still important to have in the data. It's just us as economists, we need to take that into account when we do our own analysis. So how to remove the temporary factor to try to kind of get a better sense of what's going on under the hood. And that's what we're doing. And when we look under the hood, the labor market in Canada is still weak.
Yeah, so that is the picture overall here. We have a weak labour market. I mean, unemployment down almost 2% in manufacturing, and wholesale and retail trade down around 1%. So overall, not great on the labour front.
Yeah, and the thing is that when we look going forward, we're going to still see more job losses. There have been a lot of announcements in recent weeks in the manufacturing sector of either shifts that are being canceled, some temporary layoffs. So we'll see most likely, again, another decline in manufacturing jobs going forward. The big question, and then the Bank of Canada alluded to that in their financial system report yesterday, that the weaker the labor market gets, the more it may have some negative feedback on the rest of the economy and deepening any downturn we would have.
I suppose the problem with jobs data, or almost any economic data these days, is we await the impact of tariffs, but jobs data notoriously a lagging indicator.
Yeah, well, they're lagging, yes and no, is that at some point, like the LFS is actually quite, the labor force survey, it's actually quite good. We get data right now, or this morning, for April. If we compare to GDP, we're still, we have March just because we have a preliminary number that Statistics Canada does as an estimate. So it's still, in some ways, the most up-to-date data that we can have in terms of official data. But when we can look at other more real-time data, but they're all kind of suggesting that the economy is continuing to be on the back heel.
Average hourly wages up excuse me, 3.4% year over year. A slight in April, a slight slowdown from March. But is wage growth still strong, relatively speaking?
I think wage growth is not necessarily the main concern for the Bank of Canada at this point. I think at this point, they're really focusing on one hand, we see weakening of the labor market and what kind of spillover it will have on the general economy and on inflationary pressure ultimately. But they also have to balance that with what will be the most immediate impact of tariff and counter-tariff on inflation. So yes, we had a relatively positive CPI report a month ago, but when we started, or when you kind of dig under the hood, it's not as positive as it was, because we actually saw a broadening of inflationary pressure in recent months, and we're now at a level where it's starting to be less consistent with where the 2% or with the 2% target. So it will be very important to look in terms of when we think for the Bank of Canada what the next CPI report on May 20th will say.
Would you say the Bank of Canada is interested in cutting interest rates? Would they like to do it if they had a clear, I mean, would their inclination be to do that if the data justify it?
Yeah, well, I think with the report this morning, it's clear that it's pushing toward in the direction that a rate cut at the next meeting seems to be a likely scenario. But again, they will need to balance that in terms of what's going on in terms of inflationary pressure. And there, it's a bit complicated too. There's a lot of temporary factor. We've had the GST holiday last year and the reversal earlier this year. Now we have the effect of the removal of the carbon tax. So there will need to be a bit more careful in the way they interpret the data and to really try to extract what is actually the underlying trend in price pressure.
And we are seeing, obviously, concern over export-dependent sectors. I saw a headline that Windsor, Ontario, a major centre for the auto industry, the unemployment rate has gone above 10%.
Yeah, well, it's clear that the impact of the trade war will be very regionalized, especially the way the tariffs the tariffs that are affecting Canada are set up right now. It's mainly affecting the car industry, steel and aluminum, all industries that are very important in the manufacturing heartland of Ontario. So it should be expected that, especially Southern Ontario, will be more affected by the job losses at this point. So, and that's where it becomes a bit harder, is that it's really regionalized, it's really concentrated in some part of the country.
As you know, the new government under Prime Minister Mark Carney has said it's going to cap growth in the public sector. Critics are saying that's not enough after the massive growth under the Trudeau administration. But if they do restrict public sector employment, that's not great news for the labour market.
Yeah, well, and that's where we need to be also careful and take into account that it's not guaranteed that they will start to reduce public sector workers right away this summer as soon as they release the next budget and they start to put new policies. They will need to take into account the general economic context for that, because if you start cutting at the time when you're already in a recession, you actually just accelerate and accentuate that downturn. So they will need to balance that, the current economic context.
Leave us with a final thought, Charles. Is there a threat to the economy that we're not fully taking on board right now? Or is there any misconception about the economy out there that you'd like to clear up?
Well, I think one part of it is that, for me, the labor market will be extremely key for the economic outlook. Is that we know Canadian households are extremely leveraged. They have high level of debt. Their debt service ratio is quite high as a share of their disposable income. And any job losses will put further strain on households. So the question is, the bigger the job losses are, the more we see people losing their employment, more will have stress on that side. And that could have some more negative feedback loop on the housing market, on consumer demand, and deepening the recession. So it's something that we need to keep in mind and be aware of.
Charles, we better go. Thank you very much for joining us this morning. Have a wonderful weekend.
Thank you, and to you too.
Charles St-Arnaud, chief economist at Alberta Central and a former economist at the Bank of Canada. After